Welcome to the deep dive. For the next little while, we're going to run through what feels like a really intense week in U.S. commercial real estate news.
Yeah.
It's been a period defined by these huge clashing contradictions.
Yeah, it really has.
On one hand, you had the Federal Reserve offering maybe a small bit of hope with some momentary monetary easing.
A sliver, maybe.
Right, a sliver. And then on the other hand, this unprecedented systemic political risk, specifically the government shutdown, that's really threatening core assets across the country.
And that tension, it's not just theoretical, is it? It's an immediate, pretty volatile variable hitting everyone's Q4 planning right now.
Exactly.
So today, our mission is really to cut through that noise. We want to connect these big national macro shifts right down to what's actually happening on the ground, specifically in the high-growth specialized market of Dallas-Fort Worth retail.
Okay. And we know, generally, that Texas metros, Dallas, Houston, Austin, they've pretty consistently acted as these crucial countercyclical growth centers, driven by demographics, business expansion.
Right. They have that underlying strength.
But even here in the Sun Belt, it feels like the market is splitting into really clear winners and losers. We need to understand why that's happening.
Precisely. And the goal isn't just to say, oh, DFW is resilient. It's more to show you how the strategic imperatives coming from that national distress picture directly apply to where you absolutely must position your capital if you're focused on DFW retail specialization. It really demands a surgical approach now.
Okay, let's unpack that core conflict then, starting with the Federal Reserve.
Yeah.
We got sort of a double message on rates last week, didn't we?
We did.
The immediate news, it sounded like a win. A quarter-point rate cut. That puts the target federal funds rate between, 3.75% and 4.0%.
Correct.
And that stabilization, it did seem to immediately help boost transaction volume. I mean, sales across CRE sectors already hit $42 billion in September. That's a solid 19% year-over-year jump.
Yeah, and that's the critical takeaway right there. That rate cut created this very fleeting, immediate window. For anyone sitting on maturing debt, market observers are strongly advising them, look, capitalize on this fleeting dip to lock in long-term debt. Do it right now.
It's like an emergency measure almost.
It really is against that future volatility.
Because that relief was, it was immediately tempered, wasn't it? The Fed chair followed up, citing strongly differing views within the Fed and signaling a potential pause in any further easing.
Right, and you saw it in real time. The 10-year Treasury yield actually jumped during that press conference.
Yeah, that tells you just how fragile this financial reprieve actually is.
It just confirms that any capital deployment has to be based on current certain pricing. You can't bet on anticipated future cuts right now. But now you have to layer on top of that the systemic policy risk from the government shutdown.
Okay.
And this isn't just, political theater anymore. It's become an acute operational threat, particularly for income-dependent asset classes like multifamily.
I get the political concern, but how does the shutdown become systemic right now? How acute is that risk for, let's say, November and December?
Well, it hits tenant cash flow directly. If this shutdown persists, you've got the impending lapse of SNAP, the Supplemental Nutrition Assistance Program, which helps over 40 million Americans.
Wow.
And also critical Section 8 housing vouchers. The National Apartment Association is already sounding the alarm. They're expressing real concern about widespread missed December rent payments if this continues.
That's pretty scary for property owners relying on those rent streams.
It is. And then for development, it's absolute paralysis. The Department of Housing and Urban Development, HUD, they process so much development paperwork, financial guarantees.
Right.
They're operating with only about 25% of their staff right now. So this freezes new FHA insurance policies. It halts new loan processing. It just doesn't matter if the Fed cuts rates slightly. If you can't get your necessary federal insurance or approval, the affordable housing and development pipeline nationwide is just severely impaired.
That's a really excellent transition point. It shows that, cheaper capital is kind of useless if these systemic risks block the actual development and operation processes.
Exactly.
Which brings us, I guess, to Section 2, this institutional distress we're seeing nationally, which really confirms the market is completely split, and office seems to be the bellwether of pain.
Oh, absolutely. The headlines are just dominated by forced liquidation. I mean, look at Brookfield Asset Management. They were one of the largest global buyers of office space before the pandemic.
Huge buyers.
Huge. And now they're initiating this really aggressive strategic pivot.
And when we say pivot, we mean divestiture, right, on a colossal scale.
Yes. Brookfield is set to divest over $10 billion in what they're calling non-core and struggling office assets by 2030. This basically confirms that the debt maturity crisis for older non-trophy properties, it's formally entered a phase of forced liquidation.
Hmm.
They're choosing to cut their losses now, rather than just wait for that debt maturity wall to hit with full force.
And we're seeing this distress play out everywhere. There's a suburban Maryland office portfolio tied to a $223 million loan slated for foreclosure auction,
Right.
and then a massive Chicago skyscraper just failed to pay off $250.5 million in debt that just came due.
And critically, this debt crisis is so powerful, it can even impact a strong market like Texas. Brookfield actually handed over the keys to the 4.6 million square foot Houston Center office and retail complex.
The one they bought for $875 million back in 2017.
That's the one. They handed it over to its mezzanine lender.
Wait, handed it over to a mezzanine lender?
Yeah.
What exactly does that mean for Brookfield? Are they just wiped out on that deal?
Essentially, yes. The mezzanine lender holds that junior high-risk loan that sits between the main mortgage and the owner's equity.
Okay.
So when Brookfield decided the property was worth less than the total debt stack, they basically surrendered it to the mezz lender rather than pour more capital in. It's really the highest signal of distress you can get. And it just reinforces that even in the Texas market, while it's growing, you need laser focus exclusively on high-quality, modern, specialized assets. It's truly quality or bust right now.
That quality or bust idea, it definitely extends to multifamily too, right?
Yeah.
Where supply pressure is causing this clear valuation reset. U.S. apartment rents, they've declined for 4 straight months now.
Yeah, the longest slide since 2018, and vacancy is rising nationally, up to about 7.3%.
Why the sudden shift there?
It's simply massive supply delivery. We've got a record 420,000 new units delivering across the country in 2025.
That's a huge number.
It is, and it has very quickly given renters the upper hand. It's forcing concessions from landlords pretty much across the board.
And we see those ripple effects right here in Texas. Austin, DFW's Pierce City down south. It's actually leading the nation in rent declines right now, down 5-6% year over year.
Yeah, and Dallas-Fort Worth similarly saw a dip recently in 2024 amid all these high deliveries. And just to drive home the gravity of this debt crisis, the acute distress signal is just screaming in Texas right now. Over $710 million in Texas. Commercial real estate loans are scheduled for foreclosure option this month alone.
$700 million in 1 month.
Yes, that is the largest amount on record for the state. And the majority of those are multifamily complexes from those 2021 and 2022 vintages. They just can't refinance out of these high-cost floating rate loans they took on.
That $710 million figure is just stunning. It really shows the danger of relying on, favorable macro conditions when you take on risky debt structures.
Absolutely.
So this massive level of distress, it naturally pushes investors looking for some stability toward more specialized sectors.
Which brings us, I think, nicely to Section 3, DFW retail potentially being a safe harbor.
Exactly. Retail is currently the most defensive sector out there, especially these necessity-based formats. You look at the MSCI RCA All Property Index, retail property values nationally saw the strongest rebound, up 5.5% year over year.
That's a pretty powerful endorsement for assets providing essentials. It really is.
Yeah.
And institutional capital is clearly following that signal. You see firms like Nuveen launching large strategies. They have a new $2 billion property strategy that heavily overweight grocery-anchored shopping centers.
Why specifically those centers? What's the magic there?
Well, they deliver stability. Grocery-anchored centers, they maintain very stable occupancy, often above 95%, and they consistently deliver positive rent growth, even with economic headwinds.
Because people always need groceries.
Exactly. People always need groceries, pharmacies, basic services. It's less discretionary.
Okay, now let's get really DFW specific. Here in North Texas, this necessity-based idea is like supercharged by these relentless demographic tailwinds we have.
Right.
Retail rents in DFW's northern suburbs, places like Frisco, Prosper, Plano, they've just skyrocketed. We're talking 20% or more year over year.
Yeah, rents are reaching $40, $50 per square foot, triple net.
Can you explain that term, triple net or NN, quickly? Why is that crucial for investors?
Sure. So triple net basically means the tenant is responsible for paying the property taxes, the insurance, and the maintenance costs for their space.
Okay.
So it transfers those potentially volatile operational costs away from the landlord. And when you have rents soaring this high, plus the operational risk minimized, it creates a very attractive, very durable income stream for the owner.
Got it. And even though North Texas leads the nation with, what, 17 million square feet of retail under construction, which sounds like a potential glut,
It does sound like a lot.
tenant demand still exceeds supply for the prime locations, right? It's still a landlord's market, forcing developers into these high-rent, specialized assets.
Yeah, absolutely. And we see that specialization happening in two major areas right now. First is medical retail. Developers are aggressively targeting these specialized necessity-based assets. Like there's a 48,000 square foot project just announced down in Austin.
Hmm.
And these are viewed not as like discretionary retail, but as essential long-term healthcare infrastructure. Demand there is largely non-cyclical.
Okay, that makes sense. And the second area?
The second is the expansion of these really sophisticated mixed-use hubs out in the suburbs. They're aiming to capture local spending. The $2.2 billion Riverwalk at Central Park in Flower Mound, that's a perfect example.
Right.
They're adding 43,000 square feet of new retail alongside a hotel and townhomes. It builds a true live work play kind of center.
You also see that sort of urbanization of the suburbs happening?
Yeah.
Like the new mixed-use development underway in historic downtown Mansfield?
Yeah, that's another good one. It includes 60,000 square feet of street-level retail and restaurant space. They're trying to create that walkable urban vibe specifically to keep local residents spending right there instead of driving off to a regional mall.
All of this strength, though, it hinges on continued corporate migration and residential growth. Which brings us to Section 4. And the tailwinds here, they still seem profoundly strong, despite all the national turbulence.
Yeah, the biggest validation just came last week, really. Wells Fargo officially opened its new 800,000 square foot regional campus over in Las Colinas in Irving.
That's huge.
It is. It's housing over 4,000 employees, and they signed a 20-year lease. When a major coast-based bank plants a flag that big for that long, it really validates DFW's talent pool and infrastructure for the next couple of decades.
And the residential expansion just keeps pushing further and further out. Johnson Development just acquired that massive 3,000-acre ranch up near Denton.
Right, for a huge master planned community. Could be up to 10,000 homes. It just signals DFW's growth continuing to expand all along that I-35W corridor up into the northwest suburbs.
And don't forget the healthcare investment. That's a major driver of specialized real estate too, isn't it?
Absolutely. Texas Health Plano just launched a $343 million hospital expansion in Collin County, adding 168 beds.
Wow.
And these kinds of expansions, they immediately fuel demand for surrounding medical office building or MOB development, which again feeds right back into that necessity-based retail and services thesis.
Now, even in this booming market, there are internal risks or maybe frictions, like the battle between the Dallas Mavericks, who are eyeing that massive $1 billion arena complex out in Plano at the old shops at Willow Bend site,
Right.
and the Dallas Stars, who seem to prefer a downtown Dallas location. That's not just about sports, is it?
No, not at all. It's really about billions in ancillary development rights. We're talking hotels, retail, multifamily, that will basically solidify the density pattern of either the suburban north or downtown Dallas for decades to come. So that decision, wherever it lands, will heavily influence future retail density strategies in the Metroplex.
While retail is soaring, the office market here still carries some risk. DFW's office absorption actually turned slightly negative this year.
Yeah, that's true. Partially due to some large tenants like Amazon and UPS cutting administrative jobs, which could potentially increase the sublease inventory in the short term.
Okay, so let's try and summarize the investor mandate here as we wrap up. It seems the marginal easing of capital costs from the Fed, it's just not enough to solve two fundamental problems.
Right. Problem one, the structural distress from valuation impairment in older assets like those office towers.
Okay.
And problem two, the systemic political risk, like a government shutdown paralyzing regulatory approvals you might need.
So therefore, the immediate mandate seems to be tactical speed.
Exactly. Firms really have to prioritize locking in fixed-rate long-term debt on their viable assets right now, mitigate that risk posed by the high-cost debt vintages from 21 and 22, and that potential Fed pause looming.
Okay. And for new deployment, specifically in the DFW market?
The clear mandate is specialization and ruthless selectivity. You absolutely must focus investment on resilient, necessity-based assets, so medical retail, grocery-anchored centers, and truly high-quality mixed-use projects, and only in those confirmed high-growth corridors like Collin County.
And given that acute systemic risk we talked about, introduced by HUD's regulatory paralysis, the strategy for the near future seems pretty clear. Avoid investments where your cash flow or your development timeline depends heavily on federal agency processing or, say, subsidized rent streams like Section 8.
Yeah, the political risk there is simply too high right now. You need assets that can stand on their own.
Okay.
So, as we look ahead, here's maybe the provocative thought for you to consider. We know DFW is booming, right? That's the narrative. But if Austin, its peer city, is already leading the nation in apartment rent declines because of oversupply,
Right.
how quickly could this DFW safe harbor in retail turn into maybe a speculative retail glut, especially if that corporate migration wave slows down even a little bit?
It's a sobering thought.
Yeah.
It tells us that being well-informed and just incredibly granular in your asset selection, it's not optional anymore, even in what feels like the safest market in the country.
Yeah.
The market is just moving at such an intense speed right now, where these fleeting financing opportunities exist right alongside potentially crippling systemic risk.
It means the need for specialized, knowledgeable guidance, specifically in DFW commercial real estate, particularly retail, has probably never been more critical. Thanks for joining us for this deep dive.